Hello, everyone, and welcome to the April FX monthly webinar. My name is Paul Hobson. I look after G10 FX strategy here at NatWest. And as normal, I'm joined on the webinar by Piers Leslie, who's the founder and chief analyst at Fact Not Fiction Forecasting. We'll be following the usual plan for this webinar. I'll be making some relatively short comments about recent themes for the UK economy and how that might impact sterling in the months and quarters to come. For this webinar, we're just going to make some observations about the energy price shock due to the Middle East conflict and how that might ultimately move the needle on the sentiment in the UK. And then Piers will do the second half of the webinar where he runs through his technical analysis for the major exchange rates. In these webinars over the last 18 months, we concentrated on the idea that the UK economy has relatively modest growth prospects of around 1%. But we've also made the point that the UK has become more sort of inflationary as the years have gone on, maybe because of a lack of investment, maybe because of rigidities in the labour market. And it meant that the Bank of England wouldn't be cutting interest rates that aggressively, and certainly not as aggressively as some market participants would have expected. Through that time, the new risk event that has emerged over the last 6 weeks or so is clearly the Middle East conflict. It has an impact directly to the UK and through the currency as well. And I'll be covering that off in the next 15 minutes or so. I just move to the first slide, please. So, like I did, I think back in the February webinar, I decided to move the slides around where I put our key FX forecasts right at the front, because then people can have those at hand to think about the themes that I then go on to talk about in terms of the major currencies. Also comes with the added advantage that Piers also like the fact that I put these numbers right at the front. And if Piers likes it, then that's good enough for me. So maybe just looking at the table to the top left of the screen, it's got the sterling exchange rates against some of the currencies that I get asked about more often here at NatWest. At the top, you've got sterling euro, and then you've got sterling dollar there as well. Despite the energy price shock 2.2 from the Middle East conflict, our forecasts remain relatively unchanged. We still see sterling dollar moving higher in the quarters to come. It just, we think, comes a little bit later as the fog of war clears and the conflict ultimately is more a conflict described by in weeks rather than quarters or years, and certainly significantly different, we think, from the energy price shock that we had 4 years ago, which was the Russia-Ukraine shock that really hit Europe very, very hard. So we still have sterling dollar moving up to 140 by the end of the year, potentially up to 142, but it's more the direction, I think, that's important. In terms of euro sterling, I continue to run with a really quite a flat profile. I think the risks are broadly neutral around current levels, perhaps given some of the fragilities in the UK economy in terms of fiscal policy and growth. Maybe the risks of that forecast are slightly to the downside, I think. But the difference between the two really continues to be driven by our thoughts that the dollar ultimately will weaken this year, rather than saying that it's a more positive sterling story. This first chart also has some of the risks around the UK outlook and sterling. They're the boxes on the bottom left of the screen, trade protectionism, those kind of things. UK political uncertainty, we still think that's a risk event for sterling around those forecasts. And we've also got the Middle East, the conflict there. The charts on the right-hand side just compare our forecasts here at NatWest with those of the rest of the market. So the top chart to the right is sterling dollar forecast. One at the bottom is sterling against the euro. The purple line is our forecast relative to the max and the mean of market forecasts, and the yellow sort of mustard coloured line is the average of the forecast. And you can see that we are more confident than most that sterling dollar moves higher over the year. But you can also see there's a big range of forecasts, although we're towards the upper end of the range of forecasts. The bottom hand charts, similarly, we're just a little bit more optimistic on sterling and the euro, but not meaningfully so. But here again, you can see the divergence between different views on the street. Some people are very pessimistic by the looks of it on sterling's outlook over the coming year and into 2027.
So one of the other questions I think is important is why we find ourselves in this current situation with elevated energy prices and risk aversion in markets because of the Middle East conflict. This slide just goes through 5 long-term themes, which I think is important when thinking about the current conflict, but more crucially, I think, about how it might play out over the quarters and years that will help businesses plan for the future, and also risk around the currency. So I won't go through this in a lot of detail, but these top 5 that I have on my list of key things to watch. The first one is just moving to a multipolar structure and world, where the influence of the US and crucially the dollar shifts over time, and there is a movement in the major countries in the world to exert pressure in certain parts of the world. We also have other long-term themes like climate change, which remains with us. Obviously, energy transition, the oil, petroleum out of the Middle East is part of that as well. We also have technology, whether it's AI, but increasingly the resources for technology. So whether it's rare earths or chips, and in terms of energy for data centers, all very important. Demographics as well, maybe not an obvious one for currencies, but we also have aging populations in Europe and in the developed economies, but we also have bulging young populations in a range of developing economies. And when you bring in climate change and demographics, you also bring the risk of migration. And that is the topic for domestic policies. And that leads me to number 5, where the issues in the Middle East are almost a reflection of some of the fractured politics in the US, but also how it comes through in Europe as well. And I think together these 5 things will be important in helping us navigate the future. Next slide, please. So this is just a quick slide to show how the last energy price shock of 2022, 2023 played out through the currency. So the left-hand chart is a chart of the UK's trade deficit in fuel. So we import more fuel than we export. That's an important fact. And you can see that you had a significant deterioration last time, but also how there's been no residual weakening in the trade position. Of course, this means there's just increased selling of sterling and buying other currencies to pay for those imports. And the right-hand chart is the relationship between sterling dollar and market expectations about how the trade deficits might deteriorate over time. And you can see as people priced in a really quite big impact on the current account trade balance here in the UK, sterling dollar slipped very significantly. And I think it just highlights how trade, net trade, terms of trade are important for the currency. There are other things we need to be mindful of, like the central bank reaction function. And I'll move on to that in a moment. And the same with the government and help to offset some of the impact of higher energy prices on the economy. And that has an impact on fiscal policy as well. So the impact from the Middle East conflict on the UK on sterling is multi-faceted, and we would expect that to continue. Next slide, please. So this chart tries to get at the heart of the impact of energy price rises on the economy and how it's impacting the outlook for the next year. So I quite often find these charts a good friend when thinking about how the outlook is changing. The left-hand chart shows how market expectations for the performance of the major economies changes over time. So that's the Euro area, UK and the US. And we also have the same for inflation by the end of the year. And you can see as the conflict started, people have revised down their expectations for growth across the economy. That was something the IMF was talking about recently. And on the other side, inflation, you can see that the biggest impact comes through higher inflation. And if you have higher inflation and you have relatively stable wage growth, there is less, consumers have less real disposable income to spend on the economy, and it weakens. But you can see that it's both an inflation shock and a growth shock. In terms of growth, you can see the UK is seen to be impacted more than the other major economies. Next slide, please. So this is the sort of current position of the UK. The right-hand chart is where we think inflation will be heading over the next couple of years. The left-hand chart is the labour market. And we find ourselves in a position where it looks like inflation is going to rise. Obviously, this is something that the central bank might want to react to because they have a mandate to keep inflation at 2%. But the economy is already weak. We have falling employment, we have rising unemployment. And ultimately, an inflation shock turns out to be deflationary because it hits the economy and real disposable incomes and growth. So sometimes central banks can look through it. Despite inflation going up over the short term, it comes back down to target. And I think the key takeaway for the UK is they're living with the sins of the past. From that first energy price shock, they weren't able to get inflation down quickly and sustainably. So you can see in that right-hand chart, 2002, 2003, high inflation, but it settled down above target. And it means that we think the central bank, the Bank of England, will ultimately end up raising rates by the end of the year. Next chart, please. And this chart just shows market pricing. So there's been quite a lot of volatility, but at the moment, markets expect the Bank of England to have raised interest rates by about 35 basis points by the end of the year. They thought that those hikes might come quite quickly, but they're now less confident, and they think that it will come later on in the year, and we agree with that. So we think if the Bank of England is to raise rates, it will happen at the final quarter of the year, and maybe potentially the final hike at the beginning of next year. Remember, that's different from what we thought before the crisis, where we thought we'd get one, possibly two rate cuts from the Bank of England. Next chart, please. I've got two more charts and then I'll hand over to Piers. So the outlook for the UK, regardless of the Middle East conflict, we think was challenging. This lists just some of the the things that the economy is trying to solve for, policymakers are trying to solve for. So there's a lot of important changes to the UK. So we've got low economic growth, we've got the energy transition, we've got a fragile fiscal position, we have an aging population, we've got AI adoption, we've got weak productivity, and we've got that world landscape change that is important as well. And it means that politics in the UK is very fluid. And this brings me to the final chart. And this chart just shows the fractured nature of UK politics into the May elections of the major political parties. And one of the things that happens to sterling, it does tend to weaken and become more volatile when people worry about unstable politics and the impact potentially on fiscal policy. So that, along with the Middle East, with higher energy prices, we still think politics and fiscal policy are the main risks for the currency. And that finishes the first half of this month's webinar. And then I'll hand over the call to Piers, who's going to take up the technical outlook for the major currencies.
Hi there. Thanks for that, Paul. Very interesting. If we go to the first slide, please. So I think in markets, one of the things I like on charting is that you not only have price cycles, you have time cycles. And in the start of year, January outlook, in January, I did this is my view for the year. And on the last page of that, I said, remember that what affects market is not what is known, as that is already in the price, but it's that unknown, unforecast shock, which is not known, as that is the shock that blindsides markets. Now, I did give some warnings from time cycles. So the Middle East has a lot of time cycles that go on, and I thought there could be some conflict, and I was looking at different time cycles for the Middle East. The Islamic Revolution all started off in January, February, March and April. The Islamic Revolution gave birth to the state. There's been a lot of other things out there at these sort of times, but I gave a few times to watch. I gave the first week in February as a risk area to watch, the first week in March as another risk area to watch, and then I said that April had a potential risk. There were just many all through the month, so I gave the whole month and said watch them carefully in 2026. And I think that's one of the things I like on these webinars. We can give you warnings of times to be prepared, get your hedging in place, because if those 3 dates that I gave on Friday the 30th of January, we saw Kevin Walsh was announced as the next Fed Reserve chairman. Now that wasn't anticipated for that date. The markets interpreted him as more hawkish, so higher rates than expected. Now this was late on Friday, and so the first time the Asian markets and European markets really reacted to that was the first week of February. And we saw a lot of moves in dollar, gold, silver, Bitcoin, to name a few. So there was some volatility that came through that first week. The second time I said to watch out for was that first week in March. Now, that was a very timely warning in January to sort of get things in order, get your deals in order before that first week in March. Because on Saturday, the 28th of Feb, the US started their war against Iran. Operation Epic Fury began. And the first time the markets had any chance to react to that war was the first week in March, which saw massive moves in many markets. Huge moves in oil. It was the largest weekly drop in the FTSE since Trump's tariffs. All the markets were hit. So that, I feel, worked well on a cycle basis. And April has already seen a lot of volatility around the war. We have had a lot of statements like a whole civilization will die tonight, never to be brought back again. I don't want that to happen, but it probably will. That had a huge effect on the markets the day that was said, and then the day after, when nothing really sort of happened, the markets moved again. And I still see a lot of volatility in this month. And I think the last week of this month could be another volatile time. But I'm not sure if people like these time cycle things. Give some feedback to your salespeople if you like it, if you don't like it. If I don't hear anything back, I'll just go back to just doing normal candle price charts. But so I think that worked well. Now, if we go to the first price chart that we have, this is the quarterly chart. So what's happened with the dollar? This is the dollar index. It's a quarterly chart, so each candle represents one quarter. And what we've had is a trend line since 2011 right up, and it goes to now, 2025. Price hasn't done a quarterly close below that. You can see that last quarter there was a spike below it, so we had a monthly or a 1 monthly close above it. But by the end of the quarter, price was back up above the trend line. So the trend line's intact. We still have higher highs and higher lows. So the uptrend for the dollar has been bullish since 2011, and it's still in its uptrend. Where will they start to change? I mean, look at these 3 last quarters we've had. So the last 3 green candles, not the little red bit now, because that's right now, that's this quarter, and it's only just started. The last 3 quarters, the green ones, are all within the very large red negative one. So what we can see is that for nearly 9 months, the price has just gone sideways. It's hit that trend line. It hasn't got enough impetus to break the trend line at this moment, but also it hasn't got enough impetus to move back up higher. So we can see with the sideways market, we can look where is support and resistance. Well, the resistance I gave earlier in the year, the 170, 101 area, that remains the initial resistance that they need to break above the bulls to start to move this higher. But if they really want to take back control, they need to get above 102, 104 on the dollar index. And that's when you'll start to see the dollar, a lot of people move into the dollar and think, yes, that the trend's going back up, the bounce of the trend line's intact and we're going higher. Until that point, there is a risk that price comes back down and breaks the trend line. But again, that's nice and easy. Look, we can see that black dashed line. So where is support? Support is that trend line area, around about 97.20, 97.90. So if price starts to break below that, then we know that the bears are in control and it's possible the uptrend is going to break and move us back down towards the yellow shaded area, the Ichimoku cloud. So below 97.20, 90 area, potential for the 95 area, 95.08 area. And that's where the bears really need to break to show they're pushing the dollar longer term weaker. Right, next slide, please. Now, this has been a great friend to me, this chart, for decades. It is sterling dollar yearly chart. And I've had this up quite a few times over the last few years because of its importance. So on this, we take the move, the fall from 245 down to sort of the 1 area. And then every move up and down in sterling dollar since then has been controlled by these retracements. The market needs a target. They're very mathematical. You know, when people are going to buy it, they're going to buy it, and then they're going to say, right, I need a target to sell it at to take profit. Or if they sell it, where do I take my profit on the downside? So all that's happened all the way since 1984, whenever it started that bit there. But the important bit just at the moment is this one which I've highlighted with the pink circles. The 23.6%, which is around about 137.88, every time sterling dollar got there after 1984, the market just bought it and it rallied. There was always a good rally off that area. Brexit, it broke below it. So we have something called the rule of polarity, which I've spoken about before, which is where price has been support, it switches to resistance, which is why ever since Brexit, if you look at all those candles, every time it gets to 137.88, the longer term sellers, they're not quite yet convinced it's the time to buy sterling dollar, and it's always fallen off that area. So that's going to be the key to watch this year. It closed quite high last year after backing off that area. It's gone straight on the attack for that line now. So keep an eye on that one sort of 137, well, it's more like 138, 139 area. That's going to be key. If sterling dollar can start to get above 138, 139, it means those people who've been selling it for the last 9 years up there aren't around so much. And that will give the bulls a bit more impetus to try and push it up higher. Well, we haven't got all year to wait till the end of the year. So let's look at some shorter term charts just to sort of see, are there any clues on the way? So we go to the next slide, please. So this is from the February webinar, and it's where I gave levels of resistance on the way up. So here, all we simply do is put the initial move in 2022 up to its rally in 2023. It then fell back down, and then it started to rally again. And when it rallies again, instead of putting retracements on, we can put extensions, the same ratios, but just project them up. And it's another thing that the market looks at very carefully. And you can see this has worked very well. So this was in February. I gave out this slide and had the 139.60 area marked on it and those two blue circles at 61.8%. Because if we go to the next slide, we can see it fell off that area, the 61.8%. It never managed to break it. It's never break the 139.60. So when the market starts to go back down, as I said earlier, it needs a target. And the two levels I'm always trying to talk about in FX is 38.2% and 61.8%. So look where it stopped. It stopped at the 38.2%. So for the last 9 months, sterling dollar's just gone sideways. The 61.8% has capped it, every rally up there, and the 38.2% on this chart has held it. So when it gets down there, people buy it. When it goes up to the 61.8%, people sell it. So it's going to be quite important if we start to break outside those areas. So at the moment, when something's gone sideways for 9 months, I'm not going to argue with it. It's in a sideways market. I'm going to wait for a break out of that sideways market because that will give you a signal. That's when you'll get momentum as the buyers or the sellers come in. And to help with that, we know the resistance is really that 139.60 area, sort of 137, well, maybe 138. That's our resistance. If you get above there, price is going to go higher, I feel. So where's support? So on the next slide, this is from the January start of the webinar. So I just thought I'd put it on here because the orange lines, and I call this the battle map for sterling dollar, keeps it very simple. The orange lines are the retracement of the whole move up, and I put the first two, the 23.6 and the 38.2%. And the blue retracement lines are just of last year's start of year rally. So from 2025. And here, what I'm trying to look at is where are the areas of support and resistance? Who's in control? So if we go to the next slide, I'll zoom in to the now. This is now. What's happening now? You can see that the 38.2% has held. So yes, the slide we just went on to, your last, that's it. Thank you. So on this one, I've zoomed into the battle map, the current price action. And we can see here, you have the 38.2% at 131.32. You have the 20-period moving average just above that in the 131s. So I would watch that 131.30 as a support zone. If you start to get below 131, I sort of start to worry about, look, what's happening? Where's this momentum gone? Why are we not making new highs? You want to see new highs in an uptrend. And this has been an uptrend for a few years. So for a few years, it's made higher highs and higher lows. If that starts to break, then there's going to be concern. So the 23.6% comes in at 129.5. So maybe I'd look at 129.5 against 131 and say that's where support should be if this rally is going to take off and go. You don't want to see it below there. Below there, alarm bells would start to sort of ring in my mind. Where the bulls? Where the buyers? It's the sellers taking control again. And then that, if you got that break to the downside, it it was sort of open up the 124.5, 127.5 area, the 61.8 and the 38.2% in orange. And that's where it would become very bad for sterling dollar if it were to get below there. So that would be the absolute disaster scenario for sterling dollar to get below those ones, because the 38.2% of the long term would be bad for the bulls if that broke. Right, so if we go to the next slide, please. This is sterling euro. This is my January start of year slide, and I thought it's just worth reminding how these long-term levels, these yearly chart levels, work really well. And we've had a good example of that. So the one thing I like on this is obviously that 38.2%, because every rally in sterling euro since Brexit has stopped at that line. And I was in the dealing room so many times when other people around me were getting so confident on sterling. If you want to get confident long-term on sterling, wait for that line to break. Because last year, sterling had a very poor year. Look, it opened at the high nearly, and it closed with a very large red negative body. So the 2 years before had been slightly positive, negative year last year. So that's in the back of people's minds. Oh yeah, sterling had a bad year last year. And that's why the 23.6 in the January webinar, I said, watch that 116.09 as initial resistance, and then the 118.36, which is the 20 period moving average. So if you go to the next slide, please, how did that work out? Well, look, it was held at that 23.6%. I was a bit out. I had 116.09. The high on this system was 116.12. So it got 3 pips higher than that area. But then for the next 4 or 5 weeks, it's been down. So the market's still remembering that area. And we still have that sort of 118.5 area behind it, 118.35. So that's sort of a resistance area just to keep in the back of your mind. And if we go to the next slide, we'll try and combine this all in and see if we can sort of see what's happening in the shorter term. So this is from February, and I had the Ichimoku cloud and those retracements on. And the 38.2% was at 116.5. So we had 116, 116.5 as a sort of resistance zone. And we had the base of the cloud as support, the 113.40 area. That base of that Ichimoku cloud has held sterling euro over 20 times. Price has gone down and attacked that cloud and then rallied off it. So it's working well, the cloud there. So we go to the next slide and see where are we now in relation to this. You can see that, look, the cloud's held again. So it's like 23 times now that it's bounced off there. Sort of rallying back up. But where is resistance? Resistance is exactly the same place. Sort of the 116.5 area. If it gets above 116.5, that will give the bulls some sort of like momentum and they'll feel a bit stronger. And we could see a move up towards 118.5. But initially, it's that 116.5 that's going to be capping the market, or should cap the market. And on the downside, where is support? I see support at the base of that cloud area. So I'd say sort of 112.75 and 114.04. If you start to get below 114.04, you're beginning to think, why are we back down here? And then if you get below 112.75, I think then that opens up the risk of lower levels, bigger picture in sterling euro. And the next slide, we go to the final currency, which is euro dollar. So this is euro dollar on a quarterly candle chart. And the main thing here is the downtrend since 2008 broke in 2025. And it pushed up back higher. But where did it go? It went to the 100% Fibonacci extension of the initial rally up and pullback. So I have as resistance a sort of 119, 122 area where I feel there'll be resistance in euro dollar. If it gets back up there, it should struggle slightly. But where is going to be the really big change in euro dollar is if it can get above 123.5. Because although the downtrend line has broken, the actual downtrend in euro dollar has not broken on the quarterly chart. Because for a downtrend to break, you need to break what we've had here since 2008, which is lower highs and lower lows in euro dollar. So we haven't had the higher high. We need the higher high above that 123.50 area. That's where I'd like to see it back above, because then it would say, look, the 2016, 2020 highs, they've gone. So it shows that the bulls are getting more aggressive and the bears aren't there. So that's the resistance. But what about support? What about the downside? I don't like to put too much on one slide, so I'll put them on the next slide. Right, so here. This slide, although we're going to talk about downside levels, it's just good to see why is price stalling here. We know it's the 100% extension swing, but we also know that it was the base of the Ichimoku cloud. Below the cloud, it acts as resistance. And so price has hit the cloud, had a good rally up to the cloud, and it just keeps fading at the cloud. So you want to see price pushing into the cloud to be a bit more confident on euro dollar. Now, last quarter was actually a bearish outside session. Now, it hasn't quite got the negative feel of a bearish outside session where the market opens and immediately goes lower. So this is starting to go higher. This quarter is green in the last, in April so far. But what will be important is if it can hold that area. Because if it comes down below 114.65 into, as the quarter progresses, especially at the end, then that will be an ominous sign for euro dollar. So it really needs to, if it's going to rally, it needs to do it soon and get higher. So initial support, 140.65 area, and it was a big move up. So it's a bit of a move down to sort of see where the support areas are. The next support is 112.72, which is the old highs and also the 23.6%. And 109.40 is the 38.2%. So euro dollar can move all the way down to 109.40 area and still on a Fibonacci basis be in its impulsive attack higher mode. It will just be a pullback at that stage. And it's below 109.40 that the world would start to sort of see things differently on euro dollar. But it's important to see how this quarterly candle plays out, because will it confirm the bearish outside session, or is that just a false signal and we'll get a higher push this quarter? Now, on the next slide, we had the disclaimer, which disclaims me of everything I've just said. But and that finishes it for me today. So any questions, please let us know.
Thanks very much, Piers. That was very interesting as usual. Certainly the views on the dollar and on cable, those levels that you mentioned, 131.30 to the downside, 137.88. It will be interesting to see how sterling dollar trades around those levels as we come out of the Middle East crisis, to see whether the weaker dollar trend that has been in place, we think, for the last 18 months can
and one level, sorry to interrupt, Paul, is 139.60 is a key monthly level, just to add on that, 37.88.
Okay, yeah, thanks very much. I will make a note in my jotter to keep an eye on that as well. I think that's all we've got time for this month's webinar. Just to say thank you, everyone, for taking the time to watch this webinar. We'll be back in May for when we run through our latest thoughts on the technical outlook for the currencies, but also the fundamental and economic outlook as well. Goodbye.